Hi, everyone. Let's talk about entrepreneurship, sole proprietorships, and general partnerships. In this lesson, we'll define entrepreneurship and describe the types of organizations that an entrepreneur can use to operate a business. We'll define sole proprietorship and describe the liability of a sole proprietor. We'll define general partnership and how general partnerships are formed and operated. We'll list and describe the rights of general partners. We'll list and describe the duties of general partners. We'll describe the liability of general partners and general partnerships. And we'll describe the dissociation of a partnership and the dissolution and winding up of a general partnership. Okay. So jumping in, we'll spend a little bit of time talking about sole proprietorships, but they're pretty simple, and then we'll spend the bulk of the chapter talking about general partnerships. And then in the next chapters following this one, we'll talk about limited partnerships, LLCs, LLPs, and corporations. Okay, so that's the pattern for the next few chapters for us. But anyway, defining an entrepreneur is just a person who forms and operates a new business either by himself or herself or with others. It's just somebody who ventures out on their own to start a business. That's all. It doesn't have to be any more complicated than that. Okay, if you're going to go and start your own business, and if you want to use a name other than just your name, then you're going to have to use a trade name. Okay, so you can operate under the name of the sole proprietor or a chosen name. If you choose a different name, you're going to have to do a little bit of paperwork, and some of this can be done online. But it's called a DBA, or doing business as. But basically, you file with the Register of Deeds in the office in your county to do a doing business as name statement. And you just say what name you want to operate under. That way, they have a connection between what the business's name is and who the actual owner is. If you just operate under your own name as a sole proprietor, then it's very simple. It's not very descriptive because it's just your name, but all the money would go to you personally. You would just file everything under your own personal taxes, and it's very simple. But a lot of times people just choose different names for their business. So in a sole proprietorship, the owner is the business. They're the entire thing. There's no separate legal entity involved. There are advantages and disadvantages to any one of the forms of business ownership we'll talk about. So for sole proprietorships, the advantages are very easy and inexpensive to form. There's really no formality involved here. There doesn't have to be. If you just operate under your own name, you can just go out and start doing business, and then you just have to make sure to pay your taxes. And as long as you do that, you'll be all right. The owner gets to make all the management decisions. I don't have to share decision-making ability with anybody else. I get to be the sole decider. I also get to receive all the profits. I don't have to split them with anybody. Ownership can be easily transferred or sold if I decide to sell that business later on. I don't have to get the approval of anybody else. Since I'm the sole manager, I can just choose to do it whenever I want. I don't have to observe any corporate formalities like board meetings or anything like that. I just do business and make as much money as I can. And then along those lines, no federal or state approval is required. Again, I can just start doing business. Now, having said that, it kind of depends on where you're operating, because some cities or counties might require you to get a business license just to show that you have approval to actually be doing business in that area. But if that's not a requirement where you live, then you really don't have to do anything. You can just start doing business. There are some disadvantages as well. You're going to be limited in your ability to raise capital, meaning if I need startup funds or just funds to buy a piece of equipment or whatever I would need money for, I'm going to be limited to whatever savings I have, whatever I can convince family members to give me, and then whatever I can convince a bank or other financial institution to loan me in the form of loans. So, just as one person, unless I'm just independently wealthy, then I'm going to have limited pool of money to draw from. So that makes it a little bit harder for me to grow and scale, but it is what it is. I also am going to be, and this is a huge one, legally responsible for all the activities of the business. That means I have unlimited personal liability for debts, contractual obligations, and lawsuits. Since there's no separation between the business and me, if I get into debt as the sole proprietor, the creditors, when they're trying to collect, can come after business assets as well as my own personal assets. So my personal car, my personal house, all that stuff is on the line when it comes to satisfying the debts and obligations of a business. So probably a good idea to buy business insurance if I'm a sole proprietor, to try to keep that from happening. Moving on, here's a little, I don't know how helpful this illustration is. It's trying just to say that here's the sole proprietor, here's the sole proprietorship, and any third parties that I'm dealing with, I have personal liability, the owner does, to any third parties. Now, the graph isn't really technically accurate because in a sole proprietorship, there's really no separation between the owner and the business, since they're considered to be the same thing. So maybe a more accurate graph would just have the sole proprietor here, and then owing debts or obligations to any third party, also having unlimited personal liability to those third parties. Okay, some people consider taxation of sole proprietorships to be an advantage. It could also be a disadvantage. It depends on the amount of money involved. It depends on your perspective on double taxation of corporations and stuff like that. It kind of depends. It could be considered either, but they are simpler. I'll say that. That's pretty easy to say. So there's no businesses at the there's no taxes at the business level. The business itself doesn't get taxed because the business is part of me. So I am paying taxes on my income as personal income. And then when I'm doing my 1040 form, I just have to fill out a Schedule C to state my business income and expenses to find out how much I'm going to owe in taxes. You should also know a lot of people just aren't aware, if you're a sole proprietorship, since you aren't getting W-2 wages and since you don't have an employer who's paying your Social Security and Medicare, then you're going to have to pay both sides of both of those. So that's going to be about a 15%-ish, self-employment tax that you're going to have to pay. And you have to be mindful of that. A lot of sole proprietors, a lot of business owners just aren't aware when they go in about how much money they need to hold back and save to pay the taxes that they owe. So, please be cautious about that. See an attorney, see an accountant, just make an appointment just to talk through some of the highlights if you're thinking about starting your own business. All right, switching gears into general partnerships, and here's where we'll spend the rest of our time for the chapter. But a partnership is just a voluntary association of two or more persons for carrying on a business as co-owners for profit. So this is a specific type of partnership. There are multiple kinds of partnerships. So we're going to be talking about general partnerships for the remainder of this chapter, and we'll discuss some other types in future chapters. Just like with any other form of business, there are pros and cons. So with a partnership, since there are multiple people involved, you'll be pooling resources from multiple people. That means more money potentially for startup and operations. Just like with sole proprietorships, we're dealing with individual taxation. So the business itself doesn't pay taxes, but the profit that goes to the business owners, the partners in this case, would pay on their individual tax forms. A partnership is pretty easy to form. There are some cons involved as well. Just like with sole proprietorships, there's personal liability, unlimited personal liability for debts and obligations of the business. You're dealing with multiple people, so there's shared management. So a lot of this is going to really depend on what kind of agreement you form when you start the partnership, and the partnership agreement is what it's called. But how do you divide out who's making decisions? Does everybody have equal say? Does everybody have one vote? Does one person get all the management responsibilities while other people focus on other things? How are you going to do it? If you've ever been involved in a group project and try to make decisions, it can be hard if there's a disagreement to figure out whose voice is going to win the day. And you're also sharing profits. Now, since you're dealing with a partnership, you would kind of expect that maybe the business would scale up and you'd earn more money as a partnership than you would as a sole proprietorship. That's not always the case, though. All right, to qualify as a general partnership, the business must meet some criteria. One is that it is an association of two or more persons. The definition of person is flexible here. So natural persons like you and I, individual human people, obviously can form partnerships, but artificial persons can also be partners. These are other partnerships. These are corporations, LLCs, can all be partners in a partnership. So we're an association of two or more persons. We're carrying on a business as co-owners, which means we're sharing profits and management responsibilities, and our motive is to make a profit. That doesn't always mean that we will make a profit, but our motive should be making a profit. Some laws governing partnerships. There's a group that devotes all their time to trying to create uniform sets of laws regarding business. And that's where we get the UCC from, the Uniform Commercial Code. Same organization puts out the Uniform Partnership Act, which is an attempt at, you pitch this to all the states and say, wouldn't it be great if all the states had the same or at least very similar laws regarding how partnerships work? Wouldn't that be easier than each state having their own? So they create the Uniform Partnership Act. They pitch it to all the states. Most of the states have adopted it. North Carolina has adopted the Uniform Partnership Act. The thing is that states can modify the way in which they adopt the UPA. So you can adopt pretty much all of it, but you can make little changes here and there. And over time, that organization makes revisions to the UPA. So then we call that the Revised Uniform Partnership Act, but it's not just one revision, it's multiple revisions over several years. And then each state can adopt those or not as they see fit. You can adopt some things, but not others. And so we still have kind of a patchwork of laws regarding partnerships and various other things, across the many states. But try as we best to try to create some consistency. So North Carolina has adopted the UPA. We have not adopted all the revisions. We kind of pick and choose which revisions we adopt that would be considered part of the RUPA. A little graphic of what a general partnership might look like. It's, this is kind of the same thing. So you have business owners here who are the general partners. They invest money into a partnership. Then they go out and do business. Okay, so this could be anybody. It could be banks. It could be customers, clients, whatever, any third party that we interact with. There can be debts or obligations involved. And the general partners themselves, personally, can be held liable for the partnership's debts and obligations. So you just have to understand that when you get in there. So again, business insurance, a very, very good idea in these cases to try to protect yourself. So general partnerships can operate under the name of any one of or more of or all of the partners. It's common to see partnerships stated. It could just be a list of some people's last names, Mullins, Cooper, and Smith, or something like that. That's very common with law practices or accounting practices or something like that, where it's just the names of the people that are part of the partnership. It doesn't have to be every one of them. It can be one person. It could be several, whatever you choose. Or similar to a sole proprietorship, you can choose a fictitious name. You can make up your own business name if you want it to be more descriptive than just a list of people's names. Same thing here. You'd have to file a fictitious name statement or the DBA. Again, DBA stands for doing business as. But you also have to make sure that you're not stealing somebody else's name or creating a name that's too similar to somebody else's name. And the state offices can help you search through and make sure that you're not using somebody else's business name. When setting up a partnership, we can set a duration, or we can choose no duration or just an indefinite duration. One with no fixed duration would be an at-will partnership. So the partnership just continues on in perpetuity until we decide to dissolve it. A term partnership is one in which we agree that the partnership will terminate at some point. It can terminate based on a frame of time, or it can terminate based on some event happening, whatever we choose. Okay. So it's a good idea, if you're going to form a partnership with people, to create a very good partnership agreement. It's a good idea to meet with attorneys to talk through common problems, common issues that partnerships encounter, and try to decide ahead of time how you want things to be handled in the event of a partner wanting to back out, or a partner doing something that they shouldn't be doing, or, how are we going to split the profits? How are we going to split the management responsibilities? All that stuff can be set up in the partnership agreement. That's your guiding contract. And that guiding contract, that partnership agreement, will take precedence over the Uniform Partnership Agreement or other laws. As long as the agreement isn't illegal in some way, then that will be the guiding document. Those will be the rules that a judge might use later on if there's some kind of dispute. The partnership agreement can be written, oral, or even implied by conduct. I highly recommend that it be written. Otherwise, it's going to be very difficult to prove later on. It can be tailored to suit the partner's needs and agree to almost anything, again, as long as that thing isn't illegal. Just like what I said, you can set out who owns what percent of the partnership, who's going to handle management responsibilities. Does one person get more votes than the other? However you want to do it. How are you going to split up the profits that are earned? Does everybody get it equally, or does the person who contributed the most money get a bigger share of the profits? And then how to transfer ownership. If one person wants out, how do you set up a procedure where do the other partners just buy the one partner out, or do they have to go and then find somebody to take over their shares? How do you want to handle it? Agreeing on these things ahead of time will avoid a lot of expensive disputes later on. When it comes to partnership property owned by the partnership, either being transferred in by the general partners or acquired by other means, becomes and is considered to be partnership property. At that point, it belongs to the partnership and not to the individual partner or partners anymore. Okay, similar to sole proprietorships, general partnerships don't pay federal income taxes. The income and losses are reported on the individual partner's personal income tax returns. When taxes are handled this way, it's called flow-through or pass-through taxation. So the money just passes right through the business and goes to the individual business owners. The partnership does have to file an information return with the government telling how much income was earned or what losses were incurred by the partnership. And this allows the government to check and make sure the partners are correctly reporting their income. So partners have rights and duties. So we'll talk about the rights first. Partners have rights to participate in management, to share in profits, right to compensation, right to indemnification if they incur expenses and need to be compensated for that. They have the right to return of capital if they're going to back out of the business or if the business gets dissolved. And they have a right to information. So they can demand an accounting if they think there is any shady business going on. These are good things to address in the partnership agreement when you're setting the thing up. Addressing these things ahead of time will avoid those disputes later on. Partners, depending on which version of the Uniform Partnership Agreement your state has adopted, the general partners can file an action for an accounting. just saying if there's any questions as to if somebody's mishandling funds or if there's any other shady dealings going on, they can demand information and an accounting of what's been going on in the partnership just to verify if anything has been happening. So you kind of have to understand wherever you're operating, you'll just have to understand your estate's laws. And since it's very hard for general people to look all that stuff up and understand it, it's probably best just to work with an attorney that operates within your jurisdiction. Now we're going to look at, so we looked at some of the rights of general partners. Now let's look at some of the duties they have. One is the duty of loyalty. A lot of this will sound familiar when we look into corporations and stuff like that. Just the overall purpose of a lot of these duties is that general partners should be acting in the interest of the partnership rather than in their own personal interest to the detriment of the partnership. And that kind of covers a lot of this. So just keep that in mind. That's the general overall thing as we talk about these different duties. So one is the duty of loyalty. So not acting adversely to the interest of the partnership. So there's different ways this duty of loyalty can be breached. Self-dealing, usurping a partnership opportunity, competing with the partnership, making secret profits and not telling other people, committing a breach of confidentiality by disclosing trade secrets or other stuff that other people shouldn't know, misusing partnership property or representing any party who has interests adverse to those of the partnership. Also have the duty of limited care under the revised Uniform Partnership Agreement. So again, it's going to depend on whether your state has adopted this particular part. But if they have, then that means that a general partner owes a duty not to engage in the following conduct that injures the partnership or other partnerships. So a known violation of law, intentional misconduct, reckless conduct, or grossly negligent conduct. Now, even if you haven't adopted the RUPA, then, general partners will usually have some kind of action for partners if they engage in that activity. The duty to inform means that general partners have to provide all the information relevant to affairs of the partnership. Hopefully all partners are equally informed as to what's going on and we're not keeping secrets. Because other partners are imputed with the knowledge of all notices. So if one partner knows something or has received notice of something, it's just then assumed that the other partners do as well. This can be a pretty big deal if we're talking about a lawsuit or debts or stuff like that. They also owe the duty of obedience, so adhering to the provisions of the partnership agreement and the decisions that we make as partners. Now let's talk about liability of general partners and general partnerships. So liability of a general partnership. So a general partnership is liable for authorized contracts and debts entered into by partners on behalf of the partnership and for tortious conduct committed by partners while acting within the scope of partnership business. Okay, so that's another way of saying that there's unlimited liability for the partners themselves, as well as for the partnership as a business. So we're liable for the contracts that we enter into. And if some partner is committing torts, then the partnership can be liable for those as well. So this, you could, you talk about pros and cons of a business. Now you're talking about potentially being liable for the actions of another person. It just raises the stakes a little bit. So you have to be careful about who you're doing business with. Partners do have unlimited personal liability for the contracts and torts of the partnership. We've talked about that before. Okay, contract liability. General partnership must act through its agents. Its agents are its partners and, whichever other agents we choose to engage with as a partnership. An act of a partner, including the execution of a contract in the partnership name for apparently carrying on in the ordinary course of the partnership business or business of the kind carried on by the partnership, binds the partnership. That's a very long-winded way of saying that if a partner enters into a contract, then it's assumed that the partnership itself has entered into the contract. Okay, tort liability. If one of the partners commits a tort, or maybe even one of our employees commits a tort, what are we dealing with regarding liability? So general partners have joint and several liability for tort liability of the partnership, meaning the partnership would be the joint part. So joint, all as a group. The partnership itself would have liability. And if the debts aren't settled, then whoever is pursuing us could go after the individual partners. Again, personal assets we're dealing with here again, to try to recover. So, there's all sorts of ways to try to protect your own personal assets. So that's why I always recommend dealing with an attorney, an accountant, insurance agents, just to make sure that you're as protected as you can be in the event of debts or lawsuits or whatever. The general idea is that we'd go after partnership assets first before trying to recover against the separate assets of a partner. Okay. Each partner, again, like we said, is an agent of the partnership for the purposes of its businesses. Under the RUPA, joint and several liability for unpaid contract liability of a general partnership applies. Under the UPA, general partners have joint liability, but not several liability. So again, there's nuance here, and the way that your state adopts this can make a pretty big difference. So just stating one general rule isn't as helpful as finding out wherever you're operating, what are the laws in that jurisdiction that would apply. What if I'm coming into an already existing partnership as a new partner? Maybe I'm buying out another partner's share or just adding a new partner to the partnership. General understanding would be that I'm not liable for debts and obligations that happen prior to me joining. I would be liable only to the extent of whatever my capital contribution is, whatever money I put into the business. However, after I join, then the same rules would apply to me as normal general partners, meaning I have unlimited personal liability for debts and obligations incurred after joining. For an outgoing partner, if a partner is selling out or being bought out by the existing partners or whatever, general idea is that they're liable for debts and obligations incurred at the time of dissolution, but I'm not liable for any new debts or obligations incurred after dissolution. We'll define dissolution later, but it's the basic idea is that you kind of that one partnership ceases to exist, we've dissolved it, and then we create another partnership if we're bringing on new partners. The degree to which that will be necessary to dissolve and reform, again, will depend on the state laws wherever you're operating. But the basic idea, to try to be fair, is yes, I'm liable for all the stuff that happened up to the point at which I leave the partnership. But after I leave, then I'm not liable anymore for the debts and obligations of that partnership. Okay, dissociation of a partner. This is only allowed under RUPA if your state has adopted it. This part has not been adopted by North Carolina. So if we're talking about North Carolina specifically, this has not been adopted where one partner can just leave the business and we continue operating as normal. In North Carolina, what would have to happen is if a partner leaves, we would consider the original partnership to have dissolved, and then we reform a new partnership, but we can continue operations. It's just sort of a legal formality you have to go through. But if you're in a jurisdiction that recognizes this part of the RUPA, a partner can dissociate themselves from the partnership. That doesn't cause the existing partnership to dissolve and have to reform. And maybe it's better, rather than following the UPA and the RUPA, to address all of this in the partnership agreement. Again, whatever we say in the partnership agreement will be the guiding rules that we're operating under. The UPA and the RUPA are default rules that will take over if we don't address something in the partnership agreement. So this is why it's a good idea to be very careful in the way we form that partnership agreement before we start. So examples of some things that can cause dissociation, but not dissolution of the partnership is if one partner dies, if one partner goes bankrupt and needs to leave, if one partner chooses to sell their partnership stake to somebody else, things like that, when one partner wants to leave. Dissolution, we're going to create a distinction between dissociation and dissolution. Dissociation, one partner leaves, the partnership continues on as normal. Dissolution, we're dissolving the partnership. So again, like I said, North Carolina, it would just take the form of you technically dissolve the partnership, but then you reform it with new partners, and then you continue on. Doesn't necessarily need to create any big interruptions in normal business activity. But under dissolution, then unless we just want the partnership to end, it might be that we need to wind the entire thing up and just pay everybody out. So dissolution can happen for many different reasons. The occurrence of an agreed upon event, we can just state in the partnership agreement that upon XYZ happening, then we'll just dissolve the entire partnership. It could be, if we have an at-will partnership, it could be just one partner gives notice that they wish to withdraw, and that would trigger dissolution of the partnership. It could also be, if we're dealing with a term partnership here, it could just be expiration of the term. Then the partnership is dissolved. Or it could be that we completed whatever purpose we formed the partnership for. If we formed for a specific purpose or to accomplish a certain undertaking, if we've accomplished it, then it's time to dissolve. Depending on if we're dealing with an at-will or term partnership, there could exist something that we call wrongful withdrawal. It doesn't exist for at-will partnerships. A partner can just withdraw at any time without any liability. It can trigger a dissolution of the partnership, but, they can withdraw. For a term partnership, and again, you'll probably want to handle this under the partnership agreement to spell all this out, but the general rule would be that a partner cannot withdraw for a definite term prior to the expiration of the term or prior to completion of whatever undertaking we form the partnership for. And if they do, that would be called wrongful withdrawal. And then they would be liable for whatever damages are caused by their wrongful withdrawal. So if a partner dissociates themselves from the partnership, at that point, their ability to enter contracts or act on behalf of the partnership is terminated. They no longer have authority to conduct business activity for that partnership once they've dissociated. If a partnership is dissolved, then all partners' actual authority is then terminated, except as necessary for the winding up. So just looking at whatever debts, paying whatever debts we owe, and then distributing assets back to the partners. That's the process of winding up. So once that's done, then no partners have any authority to conduct business operations in the name of that partnership anymore. One thing you have to be careful for is that you might have a rogue partner who goes out and tries to enter contracts even though they're no longer associated with the partnership. So that's what the last bullet point means. It means that unless curtailed, a dissociating partner or the partners of a dissolving partnership have apparent authority to enter into unauthorized contracts on behalf of the partnership. These are rare circumstances where somebody goes out and represents themselves as being a part of this partnership and then they form a contract, even though they don't have authority to do so. Unless that third party has been notified, either with actual notice or with constructive notice, then we could have a real issue here where some liability attaches to the partnership itself. So we have to be a little bit careful there. And that's what this slide deals with here. So if that happens, if a party dissociates themselves or the partnership is dissolved, then we should notify all third parties that we've dealt with or could potentially deal with, just so they have notice. Okay, this guy's no longer a part of our business. So now they have notice that they can't enter into contracts with that guy and then expect a partnership to recognize those contracts. So actual notice can take many forms: writing, phone call, email, text, whatever type of communication is reasonable under the circumstances. Third parties who have not dealt with the partnership before but have knowledge of the partnership can be given actual or constructive notice. Constructive notice can take the form of filing a statement with the Secretary of State, could be running notice in a newspaper. Again, I'll probably want to work with my attorney just to make sure I'm complying with the law so I don't get myself into a bad situation later on. So if we choose to dissolve a business, we're going to have to wind it up. Winding up just means that we're going to liquidate, or that just means sell, whatever partnership assets there are. We satisfy the claims of creditors, and then we distribute the remains to the general partners, either according to the partnership agreement or just following the UPA, as your state has adopted it. So the way that can be done, if I haven't addressed this in my partnership agreement already, then under the RUPA, we pay all creditors first. And under the RUPA, creditors who are also partners are treated equal to creditors who aren't partners. That's one of the differences between the revised and the original UPA. And then we settle partners' accounts after that. Under the UPA, you deal with non-creditor partners first, just general creditors. Then you deal with partners who are also creditors. Then you distribute capital contributions that the partners have brought into the business. And then you distribute whatever remains, whatever profits remain, if there are any. If the partnership cannot satisfy the claims, especially of creditors, then partners can again be held personally liable for those debts. That means they can come after a partner's personal assets, bank accounts, cars, homes, whatever. After the creditor's claims have been paid, partners are first paid cash in an amount equal to their capital contributions. So, whatever they brought into the partnership, if they haven't already been returned. And then they're paid their share of the profits from the partnership. But again, all those terms can be modified by a partnership agreement. So if we have that partnership agreement in place, then we would follow the terms of that contract. After a partnership has been wound up, and that's all done, then the partnership is automatically terminated, that it ends the legal existence of that partnership. Now, a side note at the very end is that you can have a continuation agreement as part of the partnership agreement. Again, that just deals with ahead of time. Well, what happens if a partner dies or withdraws or wants to sell out or whatever? How do we handle that? We would handle that in the continuation agreement as part of the partnership agreement. And again, that takes precedence over the UPA or the RUPA unless it's otherwise contrary to law. That's a lot thrown at you. But general idea here, if you want to be a sole proprietor and own your own business, great. If you want to, that's pretty simple. That part is relatively simple. You just have to be sure to pay your taxes and, do the best you can for your business. If you want to form a partnership, it gets more complicated. So there's all these different rules, and it's a good idea to meet with an attorney and an accountant and just make sure we're handling things correctly, because all sorts of disagreements can happen. It doesn't even matter if you're dealing with just family or what. All sorts of things can happen. So it's best to deal with problems ahead of time and be as careful as I can to try to minimize the possibility of those disagreements. And you don't want to end up in court trying to dispute this with other partners later on if you can avoid it. So that's it for this chapter. If you have questions, as always, reach out. Otherwise,